Hello, everyone. Welcome to Wall Street from Main Street podcast. My name is Mo Daoud, and today's special guest is David Quintieri. He is the chief editor of the Money GPS. David, thank you for joining us.
It's a pleasure to be on. Thank you for having me.
All right, David, before we get into the current event that's going on in the stock market and the economy, I want to take a moment and talk about your background for people out there that don't know much about you.
Yes, absolutely. So I'm the author of The Money GPS. I released that back in early 2012, and I had been writing that through 2010 through 2011. And essentially, it all began with me reading just in my own part-time and deciding, just trying to get a handle on my finances. And, book after book after book, I started finding that we're headed toward a crisis. So I collected all my notes together because I always like to really take notes and really try to really analyze the situation. And, I decided to write my own book to essentially warn the others around me. And then that spun off into a YouTube channel, and I have an email subscription list. So it's really began to snowball from there. So essentially, my work stems from my desire to help others.
That's a great story. So what kind of book were you reading back in the day? Was it Austrian economic books or
Absolutely, yes. I started with the Austrian economics, and it's, I've read guys like Rothbard and Hayek and all of these, and essentially just found it to be the most sound because, I didn't exclusively read Austrian because you want to get sort of a wide range of opinions because, you can't always just use one resource. You need to get out there and learn from others. But I found that the Austrian school was definitely one that I aligned with the most.
And what made you decide to start learning what's going on in the economy and the stock market? Was it anything to do with the 2008 financial crisis? Did that hit you personally, or was it an event?
Yeah, absolutely. That was one that really wanted to make me learn even more at that point. So essentially, that was really the final nail in the coffin, we could say, because it just goes to show you how dangerous putting all of your savings into the stock market really can be. Now, I wasn't particularly, that hurt by what happened there just because of, the way I set up my finances, but essentially for a lot of people around me, it did affect them.
Okay. So before you had the website and before you wrote the book, what were you doing professionally?
Well, basically, this is all self-taught in that regard. So essentially, I wasn't involved in this at all prior to reading the book. So this is sort of my own desire to learn.
Okay, great. That's a great story. We have a similar background then. Because after the 2008 financial crisis, I started to go on the internet and figure out why this happened, how this happened, and soon enough, I was introduced to Austrian economics, and that teaching and the theory that they have made more sense to me. And also, the Austrian economic is better at predicting what's going to happen to the economy compared to the mainstream central economic that they teach on TV and in school and college and as well. So
absolutely. The difference is that the Austrian school is not about a popularity contest, and it's not really there to, let's say, be friendly or anything like this. It's about being truthful. And when you have too much debt, you're going to have a problem eventually. It catches up to you. And although, like I said, it's not very popular to say that there will be a crash, but when there's going to you're going to face that situation, you just have to say it and face the truth.
Yeah, and I agree. And I also take time to read about the mainstream economy theories like John Maynard Keynes. I read a book about him, try to learn his stuff that he, basically made up out of thin air with no empirical evidence. And it's funny how everybody in the government and around the world is following his theory, even though there's no evidence that it's actually worked or it's actually good for the economy. And when you have Austrian economics that, prove that it works, and yet no one wants to embrace it or use it.
That's right, because well, I'll tell you, it does help, but it just doesn't help you and I. It doesn't help Main Street. It helps Wall Street, that's for sure.
Yeah, I agree. So let's shift gears here and talk about what's happening in the euro. So with Greece is a big topic again, as it has been off and on for the past couple years with their major debt crisis that they have. And they're not the only country out in Europe that has that big problem. Spain has the problem. France, pretty much almost any country, maybe except Germany, had a big problem with their debt. And right now, Greece is a hot topic because they're pretty close to defaulting on their debt unless they can negotiate with the EU. So I want to talk about that. What impact do you think Greece will have on the euro when this is all done and settled, if ever?
Well, I do see Greece as being a big issue, not because of the direct relationship between Greece and the global economy, but the dominoes that fall afterward. That's what we have to worry about. I talked about it in my book with the euro viral contagion that will take place. So although Greece is small when you're looking at, from an economy standpoint, but essentially once that is able to topple over the next countries like Spain, like Italy, who are definitely weaker in some regards, then you have this contagion that takes place. That's what really concerns me. Not necessarily Greece itself, but what happens following that. And so we have to really, really pay attention to what has occurred. Now, I've noticed that this new government that they put in place in Greece is not really, doesn't really want to leave the euro, which is, we'll have to see how that happens exactly. But with this issue that they're running into right now, they are running very, very thin on time. They are getting pressured from all sides to pay up, but we know explicitly that they do not have the funds to pay. We saw Russia sort of sticking out its hand and trying to be there to support them, but we'll have to see exactly where that goes. At this point, it's all going to happen prior to February 16th, and there will definitely be a decision made before then because they're not able to have any sort of short-term funding increases before then. So we're going to have to expect who is going to come to save them.
And they're pretty much kicking the can down the road with all the debt problem that they have in Greece. Eventually, they're going to have to face reality here and realize that this problem is pretty much unsolvable unless they declare bankruptcy or come up with another solution that doesn't require bailing out or pushing the can down the road. And it's going to be pretty interesting to see what happens once they realize the reality of their situation.
That's correct, because you can't just solve the debt problem with additional debt. You can't keep borrowing from different sources and somehow that's going to save you. It definitely will not. It's not working in any country that's doing that, and here Greece is. It's sort of in a hard place right now for this new government here, but it will be something to see. But right now, the policies in place are just not favorable at all for a solution there.
I agree. So let's continue to talk about what's going on in Europe. Now, recently the EU announced that they're going to do their own version of QE. I want to ask you, what impact will that have on the euro for the long term?
Well, first I'd like to discuss the short term, and that is it did nothing to help out the euro, but it seems to be quite interesting that every time the Fed decides to engage in a new QE, the stock market will rise. We saw between QE 2 and 3, there was essentially nothing that happened at all. As soon as they began QE 3, the stock market continued to incline. So obviously QE, at least in the US stock market, is directly linked. But we saw with the euro, they said that they would do QE, and it had really no effect on it whatsoever, and we have seen the euro drop against the US dollar. Now, in the longer term, that's something to be seen. I would suggest that they would have to print up more than that trillion they intend on doing, but it will be something to look at anyway. I'm not really sure how it will go in this regard, because simply it's going the opposite way that it tends to. Because when you print money, when you lower interest rates, you can never be sure where it's going to end up. It could end up in one asset class or another. They're trying to solve deflation by printing money, and generally that would work. If you saw what happened with Japan, they have failed at this policy. A couple decades ago, their finance minister, I believe it was, said, we have a solution to this problem of stagnation and of deflation, and what we will do is print money. We have the tools, we'll just print money. But it never worked there. So it could be the same situation for Europe as well. Only time will tell.
And yeah, with the Federal Reserve doing the QE program, we saw the euro rise against the U.S. dollar, and I don't think the EU wanted that to happen. So now they come out and do their own version of QE, and now we're seeing the dollar rise against the euro. So we're seeing this ongoing battle of the currency war, where everybody is racing to debase their own currency, and in order to enhance the export market and try to stimulate the economy. And like you said, it's going to be interesting to see where all this money printed goes into what asset class in Europe. Would it be real estate? Would it be the stock market? Or would it be some other asset in Europe? So it's going to be interesting to see.
I agree, and we could be sure of one thing: it's not going to go into the pockets of you and I. It's going to end up in those of the elite class.
And that's the unfortunate thing, that no one looking out for the middle class. People seem to think that the politician and the government cares about the middle class, but they seem to act like they do, but in reality they don't. They only care about staying in power and making sure the elite is happy, because they're the one that's keeping them in that position.
That's correct. We've seen historically, you can look back at most governments around the world. Some governments have been better than others, and you see the policies that they've put in place. Some of them are, had some very beneficial regulations put in place, or perhaps regulations taken away and safeguards there to protect the people. But overall, we've seen a decline in the middle class in most places, and that's a very sad thing for the future.
And that's what's so scary about all this, is because we had a currency war before, but not of this magnitude, I don't believe. Like, look at the U.S. They have 0% interest. Their debt is over $15 trillion. The budget deficit, it keeps growing, despite what they say, that their budget deficit shrinks. But I don't believe those numbers, because, they're spending outrageous amount of money overseas with the war going on in Syria and Iraq. So they're back in there. So that's what's scary about this, that this never happened before, and the end game it's something hopefully will never happen, but it just, the whole thing just might have a scary outcome.
Well, we know that they will always have the solution ready for us, and they are essentially categorically defining every single thing that goes on, and they do so before it actually happens. I believe that this market is totally contrived. There is no sense of realism left. You cannot really look at the stock charts and believe otherwise. If we look at some of these charts some days, and they act so erratically, oftentimes erasing losses right in the final few seconds, going up, and you know that this is there as the plunge protection team to save face on this economy, and they continue to do it. They're doing so legally. The information comes out publicly, and yet the mainstream media will not cover it. It's pretty sad, but that's why the mainstream media is losing ground on the alternative news.
And I agree with there. Now, do you believe the other central bank will have to print money in reaction to what the European Union is doing with their own version of QE?
I do believe that they will do so. There are, of course, two different policies happening, and what we're seeing is the lowering of interest rates. So we saw Australia just recently lower their interest rates. Other nations will definitely have to do so as well. And then we're also seeing nations engaging in QE, like Japan, for example. And of course, we are awaiting QE4 from the Fed. But right now, the euro is in the spotlight. So the US dollar is high. The US stock market is reasonably high as well. So they don't really need to engage in that QE4 just yet. As soon as things begin to sink a little bit and they're looking for money to suck in, then they will start up the printing presses. So every nation around the world is going to have to print because it's a system based around debt itself. You don't ever have real wealth anymore. You only have debt. Debt is the wealth of these elitists. And they're going to use that system to control us. So the more debt that our nations and those above our nations get more into that debt, we are then burdened by that. This is the way it works. They've been doing so not just for decades, but now hundreds of years. If you look deeply into it, it's not going to stop anytime soon.
No, unfortunately it will not. Now, let's talk about the Federal Reserve. There's been a lot of debate going on in mainstream media and on the internet whether the Federal Reserve is going to raise interest rate this year. So I want to get your take on that. Do you think the Fed will raise the rate this year?
That's a tricky one, definitely. I would say that they should have raised the rates a long time ago. If they do raise interest rates, I don't believe it will be of significant value. I think even if they brought it up 0.25%, for example, then it wouldn't have such a large impact on the economy. I do believe that they will bring it up eventually at a certain rate, but I don't see them bringing it up to historical averages even. So it will always have to remain very low. Now, having said that, if they want and desire to crash the economy with intention, they can bring the interest rates up to a significant level. Look at what happened in 1980. Nobody ever thought that would happen, but they did so. And what did it do? It crashed the economy, slowed down the inflation rates. And they could do this very well again. I don't see that necessarily in the near future to any level, like I said, even to historic averages. So we'll have to see where it goes. I would definitely look at, not just their rhetoric, but their actions as well. We need to keep an eye on their balance sheet too, because it's not just what they say. Even when they said they weren't printing any money during these periods of time, we saw their balance sheet increasing. So we know that they're not telling the truth. We also know that we found out about the $16 trillion bailout from the limited audit of the Federal Reserve. So we never really know what's happening behind the scenes, but definitely we can look at what Janet Yellen and the rest of them have to say, and then from there we can sort of determine where they're going to go. I would have to say at the meeting that would take place in the middle of the year would have to be our next indicator. I don't see them going to significant levels at all if they do.
And compared to the 1980s when Paul Volcker did hike the interest rate, I don't think it's fair to compare today to then, because today we have over $15 trillion of debt. And anytime they raise the interest rate, that's higher interest payment that the government have to pay on their debt. And it's going to basically bankrupt the whole U.S. government if they try to dramatically increase interest rates. And don't get me wrong, I said this before, I'm all for raising the interest rate. But I'd rather have the free market do it rather than the people in a shirt and a suit determine that. And also I believe that deflation is what we need in the economy, not inflation. So
that's correct, yes. I totally agree that, we're getting deflation in real wages. We're getting deflation in the places that the people are so desperate for inflation in some ways, but we're getting the inflation in the food prices, we're getting it in the electricity prices. So we're getting the worst of both worlds right now, and this is all because the money, real wealth, is flowing out of our pockets, and we're not able to actually benefit from all the money printing, and the only ones who are benefiting are those who are in control of the banking sector.
So let's just say hypothetically that they decide to raise the interest rate even by 25 basis points, so 0.25, up to increase it to a quarter. What impact would that have on assets such as the real estate, gold, and the derivative market as well?
At that percentage, I think it'll be able to withstand it with not too much fluctuations. Now, although the amount of interest that they're going to have to pay on their debt is going to be a problem, they're not too worried about that because, quite frankly, they don't care about the debt. They have a massive quantity, trillions of dollars of intragovernmental debt that is going on right now. If I remember correctly, it's somewhere between $5 and $6 trillion borrowing from themselves, borrowing from programs such as Social Security, and they really don't care about the debt. They will just continue to increase the debt ceiling, and that seems like the way it will go. Now, the impact on real estate is going to be a little bit bigger, particularly not necessarily in certain regions in the U.S., but if I just may choose the example, if we look at Canada, where the interest rates are very low and we have housing prices that are extremely high. And the reason that housing prices are extremely high is manyfold, but for this purposes here, we will suggest the fact that we have our ability to borrow money at virtually 0%. They're giving the money away, so surely people are going to be able to afford very big ticket items like a house. So the same thing goes in the US, same thing goes for all around the world. If you look at Denmark, have recently brought the negative interest rates on mortgages. They're going ahead with this plan, and this could be something that happens all around the world. In fact, just to keep that a certain sector going, they need to do this in order to prop it up. We can see all sorts of schemes like this. So the effect on real estate is definitely significant because if they aren't to pay more interest, they're simply going to go bankrupt. They're going to have to foreclose on their homes. Gold, on the other hand, see, here's the challenge with precious metals, is that physical gold, doesn't matter what price it's at. Physical gold physical precious metals are always in high demand, it seems. But then you look at the ETFs, you look at the futures market, and they fluctuate all the time. But those who understand sound money aren't selling any of their precious metals. It doesn't matter what happened during the financial crisis. It doesn't matter what happened a couple of years ago with the dip down in precious metals. People don't really care necessarily about that because they're holding on for the long haul. The reason that they bought precious metals in the first place was not necessarily to make a fortune off of. It's to hold and preserve their wealth, and they will continue to do so. So even if the interest rates were to rise, the paper market could fluctuate up and down, but the individual savers who are holding on to that to preserve their wealth, they're just going to continue to accumulate.
And David, one final question before I let you go is how can investors get positive return in their portfolio in this current economic condition?
Well, I would definitely say that, certain individuals will invest in the stock market. They know how to pick the stocks. They know how to generate a return on their investment. Now, although real estate is high, depending on the sector or the area that you are purchasing or looking into, perhaps around where you live, real estate could be a good investment, not for the appreciation of the home, but the fact that it offers you 4 ways to make money. But I would definitely say you don't want to invest everything you have into one particular asset. What I specialize in, what I have in the Money GPS, I call the Money GPS strategy. And essentially what the strategy is not to make money per se, but it is to preserve your wealth and essentially to not have to have all kinds of income coming in to pay off the really high rate of expenses. If you have a home and you're able to afford it now, perhaps if they increase property taxes to, really extreme highs, you may not be able to afford that home. So there are challenges that could arise from this, and that's why I use the Money GPS strategy. And just to give a very brief outline here, I know we're short on time, it is essentially you take what people have, their retirement accounts or their stock portfolios. And instead of these things, which I consider very high risk assets, if you want to call them that, I prefer solar panels to provide my own energy. I like gardens and greenhouses to provide food for myself, for my family, and then your own source of water, whether that's a nearby spring around the area, whether that's a rain catch system for to water your garden, or a well that's in your own property. And these are things that will reduce the amount of expenses you pay today so that you don't need to earn more money, so that you don't need to have the income, so that we are prepared far beyond any of the other assets. Now, that's essentially the Money GPS strategy. What I would suggest to everyone is to hold as many of the real assets as possible. I don't believe that everyone should put 100% of their money into precious metals. Although I do believe in precious metals, we should have a small amount of them and diversify outward. You want small denominations of that. I do believe that at least nominally we could see the price increase over the next period of time, but it will fluctuate along the way, and people have to be prepared for that. So if you hold a little bit of that. Now, real estate, a lot of people, they simply will say to me in my consultations with them, look, David, I can't afford all of this real estate. The housing prices are, $1 million, let's say. Well, look into things that are smaller. We need to invest in things like, for example, a storage locker. What about a parking spot in a nice area? These are smaller investments that you can make, that you can profit on today. So these are other things you need to look at. And right now, I just see paper as a whole being very risky, although there are certain cases where it could be a decent asset to hold, particularly with dividends. So that's another thing that you can look into on your own. And we're essentially holding for the long haul. The Money GPS formula, as I like to call it, is essentially earning more money than your expenses, so we can reduce the expenses as far down as we can using the strategy, and then the formula is the other side of that. So that's all I would definitely say on this topic.
Okay, great. David, well, thank you for coming on for a podcast. If people want to find out more about what you do, where can they go?
Well, one of the places they can go is themoneygps.com. They can also see me on YouTube. I have a YouTube channel over here with, we're looking at about 16,000 subscribers now. And, I post virtually every single day new video covering not just the daily news, but also deep detail for people to learn. Expanding that on there, and you can learn more about my information from the YouTube channel. So you just look up The Money GPS on YouTube, and you'll get me there. I hope to see many of your subscribers on there. We can collect together and really expand our knowledge.
Great. Well, David, thank you for coming on, and hope you can come back on again soon.
Absolutely, anytime. Thank you very much.